Hello, my name is Adrian Dale. I'm the Head of Regulation and Market Practice at the International Security Lending Association. Thank you very much to Bearing Point for inviting me to speak to you today about the Security Finance Transaction Regulation, SFTR, which has gone live for many people, many firms this year, and there's some more to go live still. I've got a small presentation that I'd like to go through with you to introduce the regulation itself. And at the end of it, I'll talk about the conclusions and the potential impacts to the market of this regulation. So first of all, I'll start off with a timeline from the inception to the end of 2018, when it starts to get a bit more exciting, perhaps. So in 2008, as many regulations have their inception in that date as well, so does SFTR. One of the things that was found or observed anyway was the lack of transparency and oversight that regulators had, especially when we're talking about security finance transactions. There are a couple of papers here that are notable. The one in 2009 by the Financial Stability Forum, which made a recommendation to G7 ministers about increased oversight and transparency. And there are many regulations that now have that embedded in them. In terms of the EU, there is an evolutionary step for them where they established the European Systemic Risk Board. And then as we get to the middle of that timeline, there was another paper, the FSB Policy Framework, which was endorsed by G20 at the tail end of 2013. And that really spoke about oversight and transparency again. And then on the far right-hand side, the last 5 points on there, I'm actually starting to focus more on Article 4 of SFTR, which is the data, so trade and collateral reporting element of SFTR. So it starts off in December 2015 with the EU adopting the SFTR regulation, which has many articles inside it. That's the level 1 text, so the initial framework for the regulation. That triggers some work after that in terms of the discussion paper and consultation paper where ESMA were gathering information from the market about how to implement that level 1 text. And it finished in this timeline anyway in 2018 with the European Commission adopting the regulatory technical standards of SFTR. So these are technical standards that show the individual fields required and the cases in which they get populated. So what is SFTR? What's actually inside it that's of interest and of impact to market participants? If we start on the right-hand side of this slide in Article 15, there was a communication required between counterparties to say that if you were to receive collateral, I'm just wanting to let you know that that collateral can be reused in some other trading activity. So it needed to be clear to counterparts the fact that collateral can be reused in that way. That went live in July 2016, so quite some time ago now. The year after that, 2 other articles went live. Article 14 was the pre-trade prospectus information that explained to funds, specifically UCITS, for instance, of the fact that that fund would be engaging in SFT activity. It would have to outline the type of activity it would be undertaking, so exactly what aspects of the fund were going to be lent, for instance, or used as collateral, and then what type of collateral you would take in against any of that activity as well. And then Article 13 was a more detailed view on the actual activity that happened. So how much has been lent and what type of collateral is actually taking in. How much does that represent of the total portfolio that was on loan, for instance, at any one time? So that was 2017 that went live. And then most recently, Article 4. So Article 4 is a reporting obligation for SFT participants to send their data into a trade repository, and that trade repository would then in turn collate and reconcile the information and provide it to the regulator in that jurisdiction that it was submitted, or for the entity that it was submitted for. I'll go into some more detail about that in a bit. So now we'll pick up the timeline again. We'll start this time in the beginning of 2019. And we've been talking about, so I spoke about the regulatory technical standards, the evolution of those, and so you can see the scrutiny ending in March 2019. And that starts off a sort of third stage in a regulatory delivery and development of another consultation to talk about the final guidelines. So now you have a regulatory text on level 1, the one that says what should be reported, broadly by who. Level 2 text being the technical guidelines of exactly what those fields are supposed to be in that. And then this last part is about how exactly do you do that, being that some of the things aren't detailed sufficiently in the RTS. So the technical standards, RTS, were entered into force in April 2019. At the tail end of that year, in Q4 of 2019, there was an ISO standard that was published, and it has the schemas, so the architectural design of the data structure that needs to be delivered to a trade repository, and this is the ISO standard. And then as we get coming to the beginning of 2020, ESMA published the final guidelines. Now, there were still outstanding questions at that point, but that was enough at that point then for firms to be writing their business requirements, having something developed, going into testing with the counterparts, and going through that whole testing life cycle to be able to go live. But as you can see, from January 2020 to April, it's not much time to do all of that. So in some ways, you could say it was fortuitous that the COVID virus came along. There was a forbearance on the phase 1. It moved to phase 2. So both phase 1 and phase 2 of the reporting obligation began in July of this year. That gave market participants sufficient time to test and to develop what needed to be done. And then the go live that happened in July actually went very, very well. The acceptance rate of data into trade repositories is currently in the mid 90% range, which is exceptional for something like this by comparison to other regulations. And then most recently, we have the reporting phase 3, which went live in October of this year, which covers insurance UCITS, AIF, pension funds, and the like. There is one more phase due to go live in January of next year for non-financial counterparts. Not so many of them in the market that I look at, but still going to be significant for people who are going live at that point. So, who's in scope for this regulation? And we can see this in Article 2.1 and 2.2. So 2.1 being these are the people these are the firms that are going to be captured. And there's I suppose the way of simplifying is if there is a legal entity that is party to an SFT inside the European Union, then it's reportable. If that party is the head office and has branches elsewhere around the world, then all of that activity in those branches will need to be reported as well. And flip side of that, if a firm who's based in another location but has a branch inside the EU and that branch is party to a transaction, then that's reported as well. So it's quite a broad scope there. What isn't reported then is where the other party to the transaction is a member of the European system of central banks. It doesn't mean they don't have to report anything at all. What it means is that rather than using SFTR as the reporting obligation, actually it's a MiFID reporting obligation, which is a different data set entirely. But there's a level of detail that's a little bit less than SFTR, which is provided for those type of activities with central banks. And indeed, like it says on the other bullet points on there, that if it doesn't have to be specifically a central bank, it can be another public body who has something to do with public debt, and they get captured under the same thing. Anyway, so a different reporting process that's required for those parties. So what actually has to be reported? Again, I'm only talking about Article 4 here. So there's the in-scope transactions are repo transactions, repurchases, securities lending or borrowing, buy, sell buybacks, and margin lending transactions, as you can see there. And then what if those are the types of transactions, what aspects of those transactions has to be reported? It's basically the conclusion, which is is the terminology being used for SFTR for when a trade is negotiated and finalised in that negotiation. Any modification that happens on that transaction through the life cycle of it. So as it relates to a stock loan, for instance, starting a transaction is just the beginning of that life cycle. Because it's out on loan, things can happen to it over that period. You can change the price on it, you can revalue it, you can change the rate that was negotiated on it, you can decrease the quantity and actually increase the quantity as well where there's a corporate action on it. So all those modifications get reported, and then finally, of course, the termination. So when the trade ends, and even though there are only 3 little bullet points on there, those points are incredibly deep and complex and have implications to market participants and how their systems work and how they interact with their counterparties. So it's a very simplified approach looking at that, but at least you can see which article is talking about what part of it. So what does that mean in terms of a trade association when something like this happens? What we did is we set ourselves a list of deliverables, goals that we wanted to reach, and obviously members were asking us to do the same thing. So the first thing that any trade association would do would be having meetings with members about this regulation and the impact of it. So those meetings require minutes and presentations, which are all this is available online to our members. There's responses back to ESMA, so in terms of discussion papers and consultations, so there should be some feedback, and we can collect members together so that we have a good representation of the market, giving feedback to ESMA, which is to some degree a shortcut for them, and it also means that we create a consensus around that response before it's sent back, which makes it much easier to read for the regulator as well. There was an outreach questionnaire which we delivered. Later on, we'll talk about communication between counterparts. But basically, if you're going to be doing a new reporting regulation, which is dual-sided, so both the buyer and the seller, for instance, are going to be reporting and that has to match up at some point, you need to be agreeing on how you're going to do that. How do you communicate with each other, the timing of it, for instance? And so a point in that would be the standard UTI, which is a unique trade identifier. So when we negotiate a transaction, we both have the same transaction identifier, which means that when it gets to the trade repository, it can match up. But how do you swap that, and who generates it, for instance? Then there was impact to legal documentation, for instance. If you're required to do reporting and you decided you want to delegate that to somebody else, you don't lose the obligation, but you can delegate the actual act of doing the reporting. That needs to have a legal agreement, and there's one of those on our website, a slightly amended version that was done in conjunction with other trade associations to cover other regulations, not just SFTR. And then finally, on that first block, we've got a modeler as well. So if you were going to do reporting, what does that report actually look like? And it'll look different for each person, each firm, depending on their perspective of that. So if you're a lender or a borrower, or the jurisdiction you're in, the jurisdiction of your counterpart, for instance. So it allowed a modeling and an example of what that transaction would look like, that data would look like. All of that combined creates best practice, which is really where the trade association is gathering together all of the collaboration and the comments that are made by market participants. It creates a best practice, which is a representation of consensus. In terms of SFTR, the best practice, whilst it would normally be a general, we recommend you do something, this one was a technical best practice, which said in the individual field, this is what you should populate, because that's what your counterpart's going to do at the same time. And then there's more chance of the two of you matching. And then, so we have, apart from the technical one with the fields and the life cycle, we also have an overview of how do I do something? How do I report if my party is in a third country, but the branch they used wasn't, or whatever scenario comes up? Any of the questions that are raised by our members, they're logged, they're brought into a working group, debated, collaboration, consensus, and then they come out in the Q&A at the end, again on our website. And so that alignment of market practice between participants, just in my market of security lending, but also aligning those best practices with other markets. So, for instance, the repo market, I'm working very, very closely with that association to make sure that our practices are aligned to theirs, so that a firm, for instance, who's doing both security lending and repo transactions has a consistent version of what they should be reporting. So here are the market impacts, the preparation points, and we've been speaking about these for quite a few years, so I'm sorry if they're getting a bit boring for some people. There are over 150 fields. I didn't want to put the exact number down because I wanted to stress that the number of fields depends on the type of transaction you're doing, jurisdiction, the part of the life cycle, and there are different templates for each of those different things. So let's say there's over 150 fields. The bulk of those are the loan and the collateral part, elements of it. There's a small part of a small set of fields which are talking about margin data, so specifically to that activity. Reuse, another part specific, about 12% of the fields that are requested. And then the counterparty, so the person you're trading with, obviously about 11% of the fields are covering that part of it. Then we have the legal entity identifier was a critical point. It appears in lots of different places, so referred to as LEI. It's a short 20-character field anyway, with an ISO standard that covers it, like you can see on there. And it identifies very distinctly the counterpart that you're trading with, and also perhaps the issuer of the assets that you're trading as well. So there's no ambiguity about exactly who it is, who is the counterpart, who is the risk with. It makes things like measuring risk, for instance, much easier, counterparty exposure, for instance. But it wasn't something that the market had before. So there's a new field we have to do something with. We have to find it. Do all of my counterparts have an LEI so that I can actually report that transaction onto a trade repository? If you don't have the LEI, then you can't report the data. We have a unique trade identifier, like I think I mentioned it before, which is a single unique trade identifier that both parties can use, and that can be used as a hook to batch two trades together, or to pair them together, rather. The reporting times was troubling for some firms. The requirement in the regulation is that you have to report on T+1, so the day after you negotiate a transaction, you need to be reporting it. That can be problematic for some because of some technical aspects, or perhaps how the system works, or the time zone they're in. But also the other part too, if you make a loan and there's collateral that's related to it, and the collateral comes in at a different time to the loan, then that needed to be the date that was originally in the regulation wasn't quite fit for purpose, and that got moved. So now it's a settlement date +1 in many cases in security lending, which is a different date to the transaction itself. There's the validation fields. There's a lot of validation fields for this regulation, and the tolerances are exceptionally tight. The market doesn't normally work to tolerances on things as much as that. So, for instance, the tolerance of a price and the valuation would have an impact on whether something's settled or not. So there's normally a little bit of leeway to allow things to settle. The requirements for SFTR is much tighter than anything we've had to deal with it up to now. So another problem area for the market, which we will overcome in some way. And then finally, the data format is a very complex way of sending things. Some people didn't have the ability, or don't have the ability rather, to report in an XML data representation. There are various ways around that, with using vendors, for instance, or trade repositories can help as well. But there are some of the big impacts that we were looking at to begin with. So when we've been talking about preparation and planning up till now, and still for some firms we're going through that, these are the type of points that we raise to raise awareness. So you have to look at what your reporting activity is, and what the scope of the scope that is in the regulation, and then how it applies to you as a firm. And most importantly then is, okay, let's say that you do have something to report, then whereabouts is the data to do the reporting? There are lots of fields, over 150, so Do I have all of those in a specific system that can do that reporting? For many people, the answer is no. There's a compliance level consideration as well of if you can't report something because you physically can't for some reason, then what do you do? Or how much time you're going to spend reconciling something if you just reported it and you say, well, that's it, I've reported what I know and that's as far as I'm going to go. Let's say that it doesn't agree with your counterpart though. So there's a consideration for the compliance level that you want to apply to this regulation. There's what your counterpart is doing, a very important point, especially if you're reliant on them for some data before you can even do the reporting. And then all of this wraps up into a term that we're using, operating model. So specific to your firm, its jurisdiction, the systems it uses, how you can communicate with your counterparts, and how you're going to finally send that data on, and which configuration perhaps of vendors and trade repositories or whoever you're going to use to make that happen. So that was the general sort of questions that were being asked in terms of identifying things for preparation. And in those planning stages, you would also want to know about the trade repository you're finally going to send your data to, whether you are or not going to use a vendor to help you with that. What impact does it have to your resources? Many firms have had to increase the number of people working on this regulation, and of course what's happening in terms of the market overall status. So that gets us to the next steps and the lessons that we've learned and the outstanding questions. So the outstanding questions are actually, we have some there with ESMA at the moment. The critical bits are about reporting. I was talking about settlement failure earlier on. If something was to fail to settle, it has an impact in terms of your exposure in security lending, and it doesn't in other markets in quite the same way because of the way the contracts are set up. That's still something that's outstanding, even though there's been some response in terms of the Q&A that came out recently, but it's still an issue for some people in our market, some firms in our market, actually the majority of the security lending market. You've got unreportable items. So for instance, I was talking about LEI earlier on. If there is an issue or LEI that doesn't exist, I think it's somewhere like about 2.1 trillion euros worth of assets that are available to the lending market. About 10% of those who are on loan don't have an issue or LEI. That means they're effectively unreportable. And then you have this issue of, do I report it and then have all the NACs, the rejections from a trade repository, and then how do I deal with that stuff? Or do I don't report it and I just tell my regulator in my jurisdiction that that's what's happening and I can't do it. At ISLA, we've been running several surveys, actually maybe 3 this year, where we've collected these the securities this relates to, and we're sharing that data with Gleif and Anna, who Anna's the National Numbering Association, so that they can help as part of their sort of advocacy to people who haven't registered to have an LEI, to increase that number, and we can see a small incremental benefits in doing that in terms of new registrations. So they're the outstanding questions. Obviously, we're going to carry on collecting new points as they come up. Then you've got validation rules and beyond. So the validation rules I spoke about earlier, they're going to be implemented over the next couple of years, and as they do, then the reconciliation work will need to increase. So we'll have to figure out a way of, as a market, collaboratively, how do we approach that, and how do we bring the tolerance levels down to the point where they meet the requirements of the regulation. That means more reconciling, obviously, so potentially could mean something either from a resource point of view or from a technical point of view. There are new issues that can come up, and of course all of these things will end up in a best practice, the one I was talking about earlier, for either the specific field level, the Q&A part of it, or a general best practice in terms of changing the way that firms interact with each other. So the lessons learned. I think that any of you that have been listening to SFTR being discussed on any panel will have heard that collaboration was one of the most important things that happened. The market couldn't have come together as it did, create the consensus and create the standards without that collaboration. A lot of it happened in trade association areas. It can happen in other places. So vendors and trade repositories also run working groups. But if you want to set the market best practice, then the trade association was the easiest place, the centralized place to go to get that. But standards actually raises an interesting point. And one of the things that we found when we were talking about this regulation is that what I think is a trade is this, you think as a trade is that, and those two things don't match. And the example that was quoted was of a partial close of a loan, where I might think it's a delta and you might think it's close the whole thing down and open it back up again. They're two different workflows, and those, when you try to report those two different workflows, will break when it gets to the trade repository. So now firms are having to represent their activity, the life cycle of the activity, to the outside world in a consistent way. That doesn't mean it necessarily was fixed internally. And then standards as well in terms of pricing, of credit rating, and those standards, in actual fact, of any of the work that I've done in the past 20 years, whenever you take a set of data, a data set, and you look at it even from just one company's perspective, you'll find inconsistencies all the way through it because there isn't enough standardization that's applied. And so there's SFTR has basically shown us or one of the lessons that we've learned from it is that there needs to be more standardization, because if you don't have that, it makes communication with counterparties very difficult. So we'll finish up with the road ahead. So there is technology out there today that would mostly fix the majority of the issues, if not all of the issues that market participants face when they look to meeting a reporting obligation. The thing is that banks don't change, or fund firms don't change that quickly. Even with when we look at the SFTR as an example, with its inception in 2008 all the way through to 2020, and we've still got one phase left to go. It takes a lot of effort to do that. And one of the reasons that happened was because the standardization wasn't there in terms of the way firms transact with each other. There was the technology, but the technology needs to be adopted and needs to be adopted consistently with the same standards of the way that it's approached. Many look at new developments with a blank sheet of paper, and of course they start off and go in a completely different direction. So I'm going to finish up actually talking about common models. I don't know whether many of you will have seen there was a joint letter from various trade associations, one of us included, and various documents that we've published. So for instance, the Agenda for Change that came out at the tail end of last year, talking about how the market needs to evolve to this point that it wants to get to, which has been discussed for quite some time, but was always the discussion always ended with it's a solution that doesn't have a problem to it. But actually there is a problem, and SFTR is showing us what it is. And other regulations like CSDR will teach us that if it comes in the way that it was originally written, that if you don't settle something on time, there'll be a fine, a penalty, and then perhaps mandatory buy-in. So that means you need to improve your settlement efficiency, improve the way that you communicate with firms. And to do that, you need to use technology and you need to use standards as well. And with all of that, we get to the common domain model, or common models that I've put on there. And a common domain model is a coded representation of best practice. So that in as much as the ISO standard I was talking about had a structure of how the data should look, it was built with one aim of the regulator would like to see this. But that doesn't necessarily mean that's the way the market works, and that certainly isn't enough to provide for the data elements that you need to have an internal system work, for instance, with different flags. So what we're working on is a pilot study, and the showcase for that comes out on the 1st of December, which you can see on LinkedIn. We have a pilot study which has a simple stock loan, and here is a common representation of it that could be standardized, and we'll build upon that to fill in the rest of the life cycle of a common domain model to provide market participants with a standard way of representing their data to each other or internally within their own systems, and it'll smooth the way to future regulations which wouldn't go like SFTR. A regulator could, for instance, say, I would like to see this, and we would say, here is the common representation of my transaction, take out of it what you want. So a very, very different approach to the way that we've approached SFTR. I hope all that made sense to all of you. I'm sorry I had to whiz through it quite quickly. There's not much time in 30 minutes. Thank you again to Bearing Point for allowing me to speak. And if there are any questions, please do contact us on this contact details here coming up. ISLA Co UK is the website, and you'll find all our contact details there. Thank you very much.